Welcome, everyone, to the 12 o'clock session on crypto and digital assets and the future of crypto digital assets. My name is Lawrence Wintermeyer, and I'm the co-chair and founder of something called Global Digital Finance, which is a not-for-profit dedicated to the safe promotion of digital assets and helping industry develop codes of conduct and better forms of professional behavior. So crypto assets and blockchain technology have really attracted the attention of policymakers around the world. I think the potential benefits and opportunities for consumers, businesses, and governments have been at the heart of this, but as well in the past year we've seen the potential risks that have emerged. Crypto assets have also attracted the attention of innovators, entrepreneurs, and investors. And without the timely development of standards, there's a recognition by both industry and regulators that misuse and misrepresentation of this transformative technology might increase. Now, following the introduction of the Howey test last year in the US by the SEC and the treatment of all tokens as securities, there's certainly evidence that the market for initial coin offerings, and particularly the utility token, is dampened. And last year at this time, on the crypto panel, I think we had hundreds of participants in one of the larger halls upstairs. The market cap of broadly cryptocurrencies, Bitcoin, Ether, XRP, etc., the total aggregate market cap was about 750 billion. And now a year later, we're down to $1 billion plus. And a lot of that was driven by the ICO, the ICO, or the token market, and early stage funding of startups, particularly around the utility token. So, you know, what a difference a year makes. I think this and the pullback that we experienced in 2017, around May, June, has really indicated to many analysts that the first wave of crypto is now behind us, and we're entering the next phase of this market where we will see more of a focus on infrastructure and standards in the development of crypto and digital assets. So I'm joined today by a very distinguished panel. I'm going to let each of the panel members introduce themselves and provide a set of opening remarks on particularly what it is that they've seen and that they are seeing in the crypto or digital asset space, with a particular focus to really communicate to you as policymakers where we think that this overall market and space is going over the coming years. So first, can I ask Martin?
Thanks, Lawrence. So my name is Martin Bardlam. I'm a partner. I co-chair the global fintech and blockchain group at DLA Piper. DLA Piper is one of the largest law firms in the world, probably either the largest or top one or two in terms of size. The importance of that is not just to say that it's a big law firm, but it's to reflect the spread of offices that we have around the world. So we're active in all major jurisdictions around the world, and that is really at the heart of what we've been trying to do and how we've been tasked with dealing with what's been happening in the cryptocurrency and tokenization digital world space. Because while it's always a pleasure to hear from my regulatory colleagues like here today, we've spent the last 3 years trying to advise companies in this kind of nascent space around how to deal with the way tokenization and development of product in this financial, quite difficult financial regulatory space should evolve. We've been through the cycle of the ICO, and I've got to say personally, I'm extremely happy to see the end of the ICO kind of ebullient market of over-enthusiasm and hype. I really do believe we're now in a period of more mature thinking around how the infrastructure is evolving. I still believe, I'm a complete enthusiast for what the underlying application of the technology can do to capital markets. And what I would say is, my belief is that this is combined with a period of change within how regulators see markets, how markets are operating, and how technology is driving the potential for change in markets. But I think we're at the point of where we might see now the evolution of a genuine global capital market. And I think that the advantages of technology and digitalization are going to be elements that are really important in that space. So I'm just briefly going to say that just without going into the detail around security tokens and utility tokens, there is still a place for utility tokens, but it always was, and it remains a relatively small space in the context of global capital markets, because most of these tokenization products are there with the intention of raising capital. And in my belief, and I think it's a belief that it's my reading of the laws around the world, I think it's the view that the regulators are taking, that if you're fundamentally looking to raise capital, then you're going to need to comply with the regulatory capital rules that apply in different countries around the world. There is a space for utility tokens, and I think that came out clearly in the FCA consultation document recently. But those utility tokens are really in a refined area around development of liquidity and kind of loyalty brands, loyalty tokenization products, not so much in the capital raising space. But capital raising is crucial for economies everywhere in the world. And interestingly, with this period of development in technology, what was happening is the venture capital world and the capital market world were not really fit for that development in innovation and enterprise, which was coming through in markets. And so almost, fortuitously, or it probably drove some of the hype, but the entrepreneurs, the people who are trying to put money into companies, build up new ideas particularly around technology ideas, were looking for new spaces where they could find opportunity to raise capital. And that's really what was at the heart of the digitalization of the product. And I'll end my introduction, but hopefully have a chance to speak a little bit more. But what we're trying to do is find a way that we can provide on a reasonably economic basis for young and growing companies to attract capital in a way that is compliant with the regulatory regime, but works on a cross-border basis. And if we can use the technology at hand to achieve that, then we will have made big strides in terms of how we develop capital markets.
That's great. Thank you, Martin. And we're only one panelist off the rank, and we're already focusing on the difference between cryptocurrencies and tokens of the utility token. So I think as we go along in the panel, we'll try to deliver a better working definition for everyone here. Ross, can I ask you for opening remarks, please?
Thank you very much, Lawrence, and thank you very much for inviting me to participate. It's really a pleasure to be here today and to appear on a panel with such distinguished colleagues. My name is Ross Lecco. I'm Deputy General Counsel at the International Monetary Fund. And perhaps what I can do is share with you, first of all, what the IMF is doing in the crypto asset space currently, and secondly, what our views are on different types of crypto assets, maybe focusing primarily on the currency type crypto assets. The IMF has a very active program of work on fintech generally, particularly with respect to cryptocurrencies. Christine Lagarde, our managing director, who many of you may have seen yesterday on the main stage, has been a driving force behind much of this work. And it's driven primarily by the fact that these types of issues fall very squarely within the IMF's mandate to promote the stability and effective operation of the international monetary system and the global financial system underlying it. We started working in this area about 3.5 years ago, and from a very small beginning, this has mushroomed into a major work program for the IMF that consists of several elements. First of all, we have a very active program of research and publication. In the past 3 years, we published 3 major studies on what were then called virtual currencies, the impact of fintech, in particular cryptocurrencies, on the structure of the cross-border payments market, and a few months ago, a major study on digital central bank currencies. We engage very actively with the industry. We put in place last year a high-level advisory group of industry leaders to help to consult with us on our work. We work very closely with our 189 member countries, having organized workshops to bring them together to exchange experiences on regulation in this space. And we work very closely with the standard setters, particularly the Financial Stability Board, my friend Lawrence, and also the Financial Action Task Force, which is the standard setter in the area of anti-money laundering and combating the financing of terrorism. And finally, through our continuous process of consultation with each of our member countries, we are engaging directly with our members on issues related to fintech and cryptocurrencies, and particularly on questions of regulation. Late last year, we in the World Bank published a study, a document called the Bali FinTech Agenda, which essentially is a comprehensive statement of issues that countries need to think about in approaching fintech and technological innovation, but including cryptocurrencies. In terms of our views on cryptocurrencies, I think one has to distinguish between private cryptocurrencies and digital central bank currencies. But with respect to private cryptocurrencies, I think we have a relatively, perhaps somewhat more balanced view than some other commentators, in the sense that we are very, very cognizant of the risks that they present, in particular with respect to money laundering, terrorist financing, the evasion of international sanctions, the evasion of capital controls, or plain simple fraud. And we feel that countries need to be very cognizant of these risks and take appropriate regulatory responses. But at the same time, we do see that there may be some emerging use cases for cryptocurrencies, particularly with respect to using them as a rail for cross-border payments and transfers of fiat currency, although there are a number of inherent limitations to private cryptocurrencies for this purpose. With respect to digital central bank currencies, I think, as many know, there's been a huge amount of work done in this area and ongoing amongst national central banks. The Bank for International Settlements a few weeks ago published a study where they surveyed, I think, between 60 and 70 central banks, and 70% of them were studying in some form the potential use and implications of issuing a digital central bank currency. I think what we have found, certainly, and I think others agree, is that there's no universal use case for the issuance of digital central bank currencies now. I think to the extent that they offer benefits, it depends on country circumstances and the precise design of the currency. But they do offer some advantages. The advantages may be more compelling for developing countries with poorer existing infrastructures, but these issues still need to be examined more closely. I'll stop there.
Thank you very much, Ross. Now I'm excited as well to get to our last panelist today, not least of which it's great to have someone from the FSB, but his name is Lawrence, and it's a statistical improbability quite often to have two Lawrences on a panel. So, Lawrence.
Thanks, Lawrence. I should say we're spelt slightly differently, so we're not really the same name. So the FSB is engaged on crypto assets issues more from the perspective, I guess, of vulnerabilities to the financial system more broadly so far. But we also have an overall regulatory coordination role that could be engaged going forward. So far, we've monitored risks to the global financial system from crypto assets, and we don't see material risks to global financial stability at this time. We've published an analytical framework on how what kind of primary risks we see arising from crypto assets and what the channels from those primary risks are to global financial stability. We published that in October last year. Some of the primary risks we see Obviously, volatility is probably high there, high among the list, but also cyber and operational risks, and liquidity or illiquidity and lack of transparency. Some of these issues that are pretty well known. The channels to financial stability include confidence effects, and particularly if these crypto assets were used widely for payments and settlements, or broadly by financial institutions and investors, including institutional investors, we may well see both confidence effects, but also wealth effects and other impacts on the broader financial system. But so far, what we've observed is that the crypto asset space is more or less a parallel financial system to the traditional financial system, and therefore the regulated financial sector doesn't seem to have been impacted particularly by the loss of market capitalisation that we've seen over the last 12 months. So trends that we see emerge, apart from the obvious more or less collapse in the price of a large number of cryptocurrencies, we're starting to see emerge a new variety of services and products that reference crypto assets, whether they be funds or exchange-traded products or futures. We're also seeing new services such as institutional-grade custody services for crypto assets. So we believe that vigilant monitoring is merited in large part because of the speed of developments and also because of data gaps. Some regulators are not, for instance, cited on the extent of, say, bank or insurance company investments in all kinds of crypto assets. So and we also perceive that a lot of the market data that's available is of questionable objectivity in many cases. So for all these reasons, we find that vigilant monitoring continues to be warranted. We're also doing work this year more broadly on decentralised financial infrastructures and the implications for regulation. This is a Japanese G20 presidency request. We're putting together a directory of crypto assets regulators, and we will be having a discussion at the FSB about whether there are gaps around crypto assets that could be or should be addressed, looking across at what all the standard setting bodies are doing, and I'm referring now to IOSCO, CPMI, the Committee for Payments and Markets Infrastructures, and the Basel Committee in particular, but also work being done by global actors such as the IMF, the OECD, and World Bank and others.
Thank you, Lawrence. And can we start off the questions with you, Lawrence? And I know Mark Carney had a view that cryptocurrency per se didn't really pose a serious threat to the financial infrastructure, the stability of the financial infrastructure. And I think we can pick up some of the comments that central bankers have certainly posed to us at Global Digital Finance over the last year with Ross. But I think in your own narrative, you're seeing a maturity, or indicating that, one, there's regulatory frameworks appearing, but two, that the nature of the product is looking a bit more institutional in this next wave of product and development with derivatives. Can you possibly comment a bit on that?
Well, we actively monitor the market both through collecting publicly available data, but also through a monitoring program of conference calls with industry participants, and also engagement with bodies like the global the GDF. So that, I think, as I said, there are new products emerging. There are products and services that are targeting institutional investors. I think so far we haven't seen mainstream institutional investors, so mainstream pension funds, mainstream insurers investing in crypto. Anecdotally, at least, the investment tends to come from the hedge funds and from the family wealth offices, in the main, or early stage cryptocurrency investors who've developed significant wealth. So time will tell whether these products appeal to banks and insurance companies, and part of that story will be what the prudential treatment of investments in crypto assets will be, and that's, I think, a tale that's still to be told. So we have seen that in Switzerland, the Swiss regulator has written to banks and suggested a certain risk weighting on a bilateral basis. I think 800% was the figure. Now, whether that develops into a standard or becomes a benchmark, time will tell. It's too early to say.
No, thank you. And Ross, last year at the IMF, the annual meeting in May, the narrative for many central bankers, following on to this, seemed to be, look, we don't have anything against Bitcoin or Ether, so a decentralized, algorithmically generated cryptocurrency, as distinct from digital or e-currency, which is the sort of thing that central bankers were speaking about. So they didn't have anything against cryptocurrencies, but were actually quite supportive of digital currencies. I know the Swedish Riksbank was looking at a digital currency. And can you just give us a focus? I know you mentioned cross-border payments and BIS as well, which seem to be one of the biggest use cases we've seen around crypto and tokens. But can you give us an idea of how you see central banks unfolding in this area, and some of the AML or regulatory models that might develop to help this along?
Sure. Well, maybe I can talk about digital central bank currencies first, and then move on to regulation for AML and cross-border payments more generally. I think, as I mentioned, there's certainly many central banks globally who are looking at the usefulness or the feasibility of issuing a digital central bank currency. And I think, at this stage, for many of them, the jury is still out. I think many don't really see the benefits outweighing the costs at this point. There are some interesting studies being done on the use of digital central bank currencies for the purposes of cross-border payments, particularly the Monetary Authority of Singapore, the Bank of Canada, and the Bank of England published a very interesting study that looked at different models for this last year, but much of it will depend on the willingness of central banks to allow non-residents to hold a native digital central bank currency. One of the big challenges, I think, that people are grappling with respect to CBDCs are the money laundering issues. Because to the extent that you have a central bank issuing the currency, and potentially people holding that currency, the tokens, on a ledger maintained by the central bank, and making transfers, particularly to non-residents, the question is, who does the money laundering, the AML, CFT, customer due diligence, and know your customer procedures? Would it be the central bank itself? Could this somehow be farmed out to a third-party provider who would do it? And secondly, what would the implications be for privacy and anonymity? So these are challenges that have to be worked out. But as I say, many central banks are looking at these things, and I guess the jury is still out in many ways. But with respect to private cryptocurrencies and cross-border payments, while there are some emerging use cases in this area, a big issue that needs to be addressed for these use cases to be viable is regulation. Regulation, I think, is the foundation of trust in the financial system, and trust is the glue that holds the financial system together. And for governments to be confident that the private cryptocurrencies, particularly in a cross-border context, will not be used for money laundering purposes, there have to be effective regulatory frameworks in place. And I think at this point, globally, there's a significant disparity in terms of the regulatory approaches that are being taken towards private cryptocurrencies. In some cases, they are banned outright by countries. In others, countries have done nothing and are simply allowing the market to develop. But in many cases, there is some emerging regulation taking place. And the regulation, I think, is focusing on 2 of 3 potential areas. If you think about regulating cryptocurrencies, you can distinguish between 3 cases. First of all, regulating the cryptocurrency itself, the technology, regulating the use that people make of the cryptocurrency, and third, regulating the firms that provide services in this area. I don't think anybody's talking about regulating the currencies themselves, but there is criminal law that prohibits people engaging in money laundering or fraud that addresses the uses. But with respect to how to regulate the firms themselves, particularly virtual currency exchanges, there is some emerging practice, particularly specifically in the anti-money laundering area. I think the Financial Action Task Force was very, very early out of the gate in providing guidance to its member countries on how to address the money laundering risks associated with private cryptocurrencies, including in a cross-border context. And essentially what they've done, now enshrined in an amendment of the FATF AML-CFT standard last October, is to require certain types of service providers, particularly exchanges, virtual cryptocurrency exchanges, to engage in roughly the same type of customer due diligence and know your customer procedures that banks engage in. And I think this is providing some helpful guidance to countries.
Well, thank you for that. Martin, let's move back to tokens and where we were again last year. In the spring, we were at the OECD bringing industry together with regulators, and the big discussion in it was April of last year was the utility token. And I don't want to get into great sort of discussion of taxonomy, but we felt it was very helpful for industry and regulators to come together because, in essence, we looked at the utility token, which most of the early stage companies were doing to raise risk capital broadly as a product. And our sort of go-to from David Yermak at NYU was he felt the very first utility token ever issued was a Wimbledon debenture, where Wimbledon needed to raise some money 50 or 60 years ago and sold seats to fans as a debenture, and that seemed to be the first utility token to him. And we liked it because Martin was the sort of author of what we called an AB token. You wouldn't use 100% of your capital raise or risk capital, particularly for a utility. And so these were the sort of discussions that we were getting in, and the SEC seems to have really dampened that whole environment anyway. But since then we've seen the rise of the security token and in fact stable coins as distinct from digital currencies or central bank digital currencies. So I'm wondering if you can give us a sort of commentary now that we've seen the pullback in the market, security tokens and stable coins emerging, and particularly what we can expect from that, and the sort of instruction for regulators or policymakers around the use cases for those.
Great. So trying to put that into context. So through 2017, 2018, I mean, a lot of new entrants to the market came at the market on the basis that if they were doing a digital token, then that was somehow not a security. And this was initially, I think, naivety. I think that evolved into certain opportunities for fraud and certainly misuse of the sector. The SEC came out with strong statements around what it would do. We've seen other regulators come out with statements around they're not accepting the argument that just mere digitalization of a product means that it somehow ceases to be subject to the traditional securities rules. So there's been a clarification, and I'll do very quickly the example I give around the cinema, because I think it brings home to people. So the example I normally give around this differentiation of these two different types of product is, if you're a cinema owner and you wanted to improve your system, a very simple approach would be, traditionally all around the world, people buy tickets online, they go to the cinema, they put their card in a machine or go to the desk, and they get a paper ticket. They take that paper ticket to the door. Somebody there tears it in half, and you go to your seat. So you can see inefficiencies in that system. In a modern digital world, why not just be able to download off the internet a code onto your iPhone? When you arrive at the cinema, you just show your iPhone to the entrance to the door of the cinema screen, and you go through. It saves the cost of the machines. It shows the cost of manual labor in terms of tearing these tickets. It's more efficient. No reason why that ticket can't be transferred. If you can't make it that night, why can't your children or your friends use that ticket? And indeed, no reason why you can't sell it. If you want to get your money back and there's demand for a particular film and there's not enough availability, why can't you sell it at a profit? None of that suggests that ticket to see that film is a security and that you would have to go through some kind of security regime in order to download that ticket or sell that ticket to somebody else. So that is the kind of utility token type model, that basically it's facilitating through digitalization the process of a digital asset to do something, which is basically use that time in watching that film. Now, the cinema owner has such a great success with his new model that he decides, well, wouldn't it be a great idea if I sell forward a million of these tickets, and that way I raise a ton of money so I can build a cinema in another town, and these people still have these, all they have is a digital right to go and see a film, but they can sell that to other users, and therefore, I'm not really selling a security, am I? It's not really an equity security. Well, of course he's got all the characteristics of being a security in some form or other. It feels like an equity security. It's risk on the business, it's risk in the development of the building, it's risk as to whether the business will succeed or fail. It's probably sold, if there's any meaningfulness to it, it's probably sold at a big discount to its face value, the value of the tickets, because there's a risk profile in there. And that equity discount is really where the return is being generated. A lot of the early tokens were around that model. They'd be sold at maybe a 70% discount to their face value on the basis that when the network was built, you'd be able to use this token and you get your return at 3 times your original investment. So initially there's a lot of confusion and lack of clarity, but if you actually analyzed it, you could really tell quite clearly when you were dealing with something that was close to being a security and when you were dealing with something that was really just a digitalization of an asset. Anyway, the result of that is that very few people now are coming forward and asking, that we write documentation for them on the basis that it's a utility token, because in most cases, there was, at least in part, a desire to raise funding, and there's an acceptance that if you're raising funding, then it probably has characteristics that are similar to an equity or other security, and therefore it has to go through the securities regime, where it's the US or it's the UK or it's Europe or wherever that may be. Now, the issue we spent a long time educating people towards was that shouldn't be such a big fear. This idea that you've got to comply with the securities regime. The securities regime wasn't established to prevent people from raising capital. Every government in the world wants to see the ability to raise capital in its economy, because raising capital, particularly at the SME level, has been businesses, governments have realized that is the driver of your economy. So if you prevent the development of capital, particularly at the SME level, then you're really significantly holding back your economic growth in an economy. And if other economies just are applying appropriate models to develop capital, then they're going to get ahead of you. So there's a recognition that the mere fact that you've got securities laws applying shouldn't be prohibitive to the development of capital. And so this goes to answer Lawrence's question. So now there's we've been involved in quite a large educational process towards businesses around why if you're complying with the security regime, that isn't something which is either economically or from a regulatory perspective prohibitive. It's a regime which is intended to provide rules and regulations which protect the way the industry works, and to provide models and codes which the industry comply with, both to protect the issuers and the investors in those businesses. And as long as those are adequately recognized and people comply, it shouldn't be, it's economically prohibitive, and it shouldn't be, it shouldn't prevent people from forming capital. What was potentially going wrong with the capital system that we had, and I mentioned this in my introduction, was that at the venture capital level, we were increasingly narrow in terms of the intermediaries that were able to present venture capital. So there was venture capital houses and investment banks which became incredibly, because of demand and supply functions, very controlling in terms of what they would offer, the circumstances in which they would offer capital, controlling both in terms of the price of capital and in terms of the controls they would put on entrepreneurs that were developing businesses. So preemption rights, board representation, controls over activities of businesses. And at the larger level, the capital markets were being restricted to really large cap companies and almost exclusively in that large cap environment. So there needed to be a model which would allow for development of capital at a smaller scale, SME, venture cap level. Now we are in the process of evolving that model, looking at blockchain, looking at the way that the rules work, seeing if we can find ways of using technology to ease the process. So we're working now with technology providers to look at ways where we can comply with the regulatory regime in multiple countries at the same time without breaching securities regulatory rules in any particular jurisdiction. And making that more of an open model for capital raising, whether you're in the UAE or whether you're in the US or whether you're in London or elsewhere. And the technology is coming to help that. So securities tokens are really a way of digitalizing the equity product, but I also think there's a more interesting process that's going on globalization of the way the equity raising process works. And stable coins are really a form of asset-backed security, which is a token which is backed by a real asset in some shape or form. I mean, initially these were logical in the sense that people who held cryptocurrencies, crypto assets, were looking at ways of moving that crypto holding into crypto assets that were genuinely backed by real assets, be they property or gold or currencies or some other physical asset. The problem for both of these two developing areas, the security tokens, equity-like digitalized product, and stable coin, where it's kind of commodity-backed, asset-backed, security-type tokens, there's been a difficulty because so far there hasn't been a maturing of the system around custody and exchanges. So the lack of exchanges means that you're really restricted in what you can do after the primary issuance phase. But we're seeing the evolution of that secondary market. We're seeing exchanges come forward. We know there are several with the FCA. There are several around the world now that are coming forward to develop a potential primary and secondary market for these kind of assets. And then custody, and the interaction of the monetary system and the digital system is crucial. And that's an area that I really hope we see development, working together with the regulators on how the monetary and the traditional monetary and the digital systems can come together in a safe environment where proper custody safeguards are in place, but we still have the ability to develop more fluid, more liquid, more effective global capital markets.
Thank you, Martin. I'm just going to hand over to Lawrence in a second for a comment, but just a couple of quick things. One, it seems to me that this whole discussion of custodians or custodial rights, or how that's going to work in the digital token currency ecosystem is pretty big right now. But just getting back to the point you made, and particularly looking at the price of cryptocurrencies, Michael McDonnell from Bloomberg produced a chart I saw, I think probably at the end of May last year, early June, where he was correlating the Bitcoin price to the NASDAQ in 2000. And it was perfectly correlated. So I think the hypothesis in our own community is that broadly, it looked to be a lot of a professional capital rather than retail capital in the ICO or in the ICO market that was driving those crypto prices, and that's how we concluded things by the end of the year. But Lawrence, you had a comment or a point to make about Martin's narrative?
Well, I guess on regulation, we are seeing quite a lot of things going on in that space. At the national level, we're seeing countries like France experiment with special purpose regimes. So in the French case, there's a bill for ICO or tokens, I should say, that fall out, or what they call jeton, which is a token in French, that fall outside the MiFID boundary of financial instruments. There would be a sort of opt-in regime for ICO providers, and there'd be standards around white papers and so on. So a kind of form of crowdfunding light, I guess. ESMA, the European Securities Markets Authority, has recommended to the European Commission the establishment of a special purpose regime for tokens sales or token issuance outside the scope of MiFID. They've also said at events I've attended, for tokens that are within the scope of MiFID, securities regulators really do need to be enforcing the rules that are already there. I think that goes to reputation. We've seen the UK put out a very interesting discussion paper on crypto assets and the regulatory perimeter. We've seen Singapore and Hong Kong also issue papers quite recently. We've seen jurisdictions like Malta, Gibraltar, Isle of Man and others, offshore jurisdictions that are not FSB member jurisdictions, press ahead with local specific purpose regimes. Time will tell how successful they are. In the States, we see New York Department of Financial Services has a BitLicense regime, and we engage with these as well as with the stablecoin issuers to seek to understand what's going on. And I mentioned before what the global standard setters are doing, but just not going into all the details, but IOSCO, the International Organization of Securities Commissions, has an ICO network for exchange of information. It's also developed a so-called support framework, which is an analytical tool to help securities regulators work through the issues around trading venues and the like. And they're also working on issues around trading platforms. I guess issues would include, custody and cyber, and also issues around fund exposures too, and collateralization.
No, thank you for that, and grateful in that the FSB do opening remarks in all of our global digital finance roundtables, particularly covering the regulatory landscape. Ross, if I could finish up with you, just a couple of points, but we were speaking earlier. Christine Lagarde is really our sort of poster hero in the digital assets world, in that she really champions, many assets of digital assets. Some of the areas that I'm, particularly personally involved in organizations around opportunities, particularly outside of what we call the non-G20 countries, to drive financial inclusion, to help central banks, policy regulators outside of, again, focusing non-G20, the non-G20 landscape. But can you give us an idea of what the IMF is doing in that space to help policymakers and central bankers think about this, quite a emerging but quite fragmented roadmap?
Well, first of all, just to pick up on Lawrence's description of the huge diversity of approaches that exist in this space, it just demonstrates that we're still at a very early stage, with the possible exception of money laundering legislation, in developing best practices or standards that would apply more commonly across the membership. But what that points to is the need, I think the enormous need for international cooperation and exchange of experiences in how to approach these issues. And the IMF and I think other international organizations like the World Bank that have effectively universal membership, I think, are well placed to help in this space. What we are doing, first of all, is to bring countries together. If you're in a world where there are not international standards in place yet, it's essential that you bring countries from different levels of development in different regions into the same room to have them exchange experiences on how they're approaching these issues. I have to say that the need for, or the call for advice and assistance from the fund, from its membership, is almost universal. There's an enormous demand for this. But what we do, first of all, is to bring them together to exchange experiences. We are holding workshops, not only in Washington, D.C., but in our many training centers around the world. And we're engaging with countries on these issues on a bilateral basis increasingly, listening to what they're doing and trying to help them understand comparative experience from other countries. Thank you.
Well, thank you. And I think we're at the end of our time. I'd like to personally thank each of you. And a year actually is quite a long time in crypto. It was a year ago that we set up Global Digital Finance again, which is a not-for-profit with an objective of really being the voice of industry, but trying to work with global policy makers and regulators to develop standards and codes of conduct. And I'm very grateful because we've had huge support from the three gentlemen in the organization, the organizations they represent in developing codes of conduct with industry and cooperation with policymakers, regulators, and we'll keep going on that. So thank you very much to the panelists. It's been a fantastic panel, and thank you very much to the audience for listening to us, and thank you to the World Government Summit.